Cash, wonga, dosh, loot, moolah, paper, bread and honey. Whatever you call the stuff, knowing how much money to keep on the side has been an age-old question and a debate amongst professional and rookie investors all around the world. Some say cash is king, others say cash is trash.
Cash is trash.
But what's the truth and how much money should we keep to one side? And that's exactly the question that I'm going to try and answer in today's video, so by the end we should have a much better idea what's going to be right for us. So why should we hold cash in the first place? What's the argument for doing this? Now, for everything I talk to you about today, I'm going to assume that you've got an emergency fund already put to the side, so that's around 3 to 6 months of expenses, so we're not going to include this at all in our cash pile that we need to have on the side. That's our emergency fund. We don't want to trust that. We don't want to touch that at all. We need that to be left there just in case there are any life's emergencies, anything needing to be done to the house, your car, your redundancy, if you lose your job, for example, that is a separate pile completely. We all know that the stock market can be an incredibly volatile place. You've only got to look back to 2020 to show you how much the swings can be, and if you just pick any random company, you'll see that the average buy price across a 52-week period can be anything from 50% difference to 300% difference. Being able to take an advantage of an opportunity at a certain time is absolutely critical, and of course many professional investors will say that actually the money is made when you buy a stock, not necessarily when you sell it, because you want to get it for the absolute best price. It's all about getting the absolute best deal and the best opportunity for your money. If you'd managed to time the market back in 2020 and bought all of your stocks toward the end of March, whether that be Amazon, Tesla, NEO, or pretty much any company, to be honest, you'd be riding high and you'd be laughing all the way to the bank. And of course, if your money was already tied up in something, and tied up in property or tied up in other stocks, and you couldn't react to those market conditions, well, that's just your luck. Sorry, you didn't have any cash on the side. Tough luck, right? For one person, it's a market correction. For another person, it's a fire sale. Outside of the stock market, though, don't forget how useful cash can be, whether that's buying up property, buying up real estate in a crash, buying a commercial property, for example, buying someone else's business. Having cash on the side can be a huge benefit, not just looking at the stock market, but generally as an entrepreneur or as a business person, being available to take an opportunity at a moment's notice can be extremely invaluable. Warren Buffett and Charlie Munger of Berkshire Hathaway have always been huge supporters of having cash, and they have a minimum set between them. They always want to have $20 billion sat there just in case they want to go ahead and buy something. And although $20 billion is a huge amount of money for most individuals and most companies, for them, with Berkshire Hathaway being a $650 billion company, that's only really around 3% of their organisation. Now, in reality, their cash pile has grown a little bit bigger than $20 billion, and it's around $150 billion right now. So that's a little bit over 20%, so that might be on the rich side, but of course, nicer problems to have. It's very safe to say that Warren Buffett and Charlie Munger sleep very well at night. On the other hand, though, when you've got those kinds of sums of money, it's actually very difficult to invest it, because there's only so many companies that you can actually buy without buying up all of their shares. Nice problems to have, though. Let's dial things back a little bit, though. What about the average investor who puts money into the stock market every month and just has a normal full-time job and doesn't really pay attention too much to share prices in individual stocks? How much should they keep aside just in case they see a fire sale or just in case they need to react to the market? Do they really need any more cash than their emergency fund already allows them? Is it more than just a pure crude financial decision? Are you happier knowing that some of your portfolio, 5, 10, 15% is sat in cash even outside of your emergency fund? Will that mean you'll sleep better? Will you care less about everything going on in the market? Are you happy taking that risk knowing that your cash sat there doing absolutely nothing is losing its purchasing power? And that's only a question that an individual like you can answer. And also, we really need to take into consideration where you are on that journey. Once you've built up quite a substantial portfolio, your main job is worrying about how to protect it, versus when you start, you're happier to take more risks because you've got pretty much nothing to lose. So now let's look at all the arguments against holding lots of cash, or holding maybe any cash at all. First things first, cash's main arch nemesis,
hello there,
inflation. Over time, as we know, our money in our pocket loses buying power. As time goes on, as weeks go by, that $100 today will end up being about $98 or $97 by the end of the year. Governments and central banks around the world typically try and keep inflation around 2%, but of course we've seen recent times how high inflation can get to, and we've got no idea how far it's going to go. We've got no idea if it's transitory or not, but what we do know with 100% certainty is inflation will eat up our money faster than the Cookie Monster. And of course, we've only got to look around us at the moment to see soaring prices in the stock market, soaring house prices around the world, and a soaring crypto market to see that there must be something else going on, and there must be some kind of consequence to all the money being printed around the world. So the more cash we hold outside of that emergency fund, the quicker that cash is going to deplete year on year, and we need to do something about it. And although we might be waiting for the right opportunities to come along, well, what if that opportunity never does come along? And what if that pile just diminishes year after year and we should have just had it invested in the market with the rest of our money? Inflation's always a difficult balance, but again, we do know with 100% certainty that inflation will eat away at our money, so the risk there is guaranteed. So unless we do something with it, it's going to get lower. Secondly, we've got record low interest rates and terrible bond yields. Whether you're a saver in the UK or the US or some other part of the world, unfortunately right now, savers are getting penalised hard. There's no way to make any decent returns holding your money in someone's bank account somewhere, and at the moment, even if you try and search for the best rate, you're looking at 0.01%, 0.1 or 0.2% for example, which is absolutely terrible return. Whatever you do with your cash, you just can't catch a break right now if you're trying to get savings returns. And of course, if you try and look in the bond market where historically you've had some nice steady numbers, typically not quite beating stocks, but still giving you some healthy returns to beat inflation, I'm afraid at the moment you're not in luck. The only way you're going to make money in bonds right now is by looking at the junk bond market and looking at some very dubious investments indeed. And I think if you're at the stage of looking at junk bonds or some kind of bonds from some corrupt government around the world, then I think you need to give your head a little wobble and have a little lie down. In the past, trying to have that balance of how much equity you have and how many bonds you hold has been invaluable to investors to try and weather out the storms with the ups and downs. But unfortunately, we're in a place now where potentially bonds are not really even an option, so that just leaves us with either equities or holding cash. Thirdly, while you're waiting there for opportunities, we know that we can't time the market. And I know I say it time and time again on this channel, but you cannot time the market. You've got no idea when those highs are going to be, no idea when the lows are going to be, so you've got really no idea when to buy or when to sell to maximize your money, and you'll end up probably just losing money in the long term. As Peter Lynch says, one of the most famous investors and money managers in the world, more money's been lost trying to prepare for corrections and trying to prepare for those downturns than would have been lost during the downturns anyway. And as much as our egos want to say that we're better than the 90% of fund managers who lose money over the long term and think we can do our individual stock picks better, in reality, history has another lesson for us. So why hold cash there for an opportunity which might never come along, and for an opportunity we can't time anyway? And finally, tying back to all the other points against holding cash, well, what about the opportunity cost? The longer that cash sits there for, and the longer we can't utilize it, what if an opportunity never comes along? What if the bull market we're currently in today, which is the longest run we've ever seen in history, just keeps going on? What if the housing market never corrects? What if the stock market never corrects, but before it corrects 20%, it increases another 20, 30, 40%? At that position, we've got our cash pile sat there, diminishing returns. What do we do? So as you can see, it's a really, really difficult line to walk. That being said, what's the correct amount to hold, and what would my recommendations be? Well, this all depends on where you are as an individual. I'm sorry again to say that this answer is a it depends answer, and we can't just give a round percentage like 5, 6, 7% or something like that. But let's look at 3 different kinds of investors and maybe suggest some sort of rough guidelines that we might be able to work around. Firstly, let's say you're the average person, the person who's maybe started investing quite recently. They put their money in every single month to a low-cost index fund or ETF. They focus on their main job or their main career, and they don't really want to get involved in day-to-day stocks. They've already put to one side their emergency fund of 3 to 6 months of their expenses. Then my opinion and my guide to them would really be, you don't need any cash at all. In my opinion, the average person there and the average investor, which I would even throw myself into, really just need to stay consistent over the long run. Trying to build up a separate pot of cash for that opportunity which may not come along and they don't really know what they're looking for necessarily is just a waste of an investment. And having that emergency fund there means that they don't have to sell their assets and don't have to interrupt that compounding effect unnecessarily. The only caveat I would have for an average person would be if having a separate cash pile or another fund separate from their emergency fund is going to make them sleep at night or feel genuinely better about their investment, then go ahead. It's your life. Okay, so now what about a more experienced investor slash entrepreneur, maybe a business owner or someone who's got a bit more going for them on the side or different side hustles? In this scenario, I can definitely see cash being a little bit more powerful for them, and they might want to hold a slightly larger selection of cash in their portfolio. Let's say especially if you're a business person or an investor in an area which means you need to act very quickly. Let's say your side hustle is properties and real estate, and you need to act fast when a deal comes to market. Well, certainly if you haven't got free cash flow that you can free up and quickly go to that deal, then you're potentially going to lose out. And you don't really want to dip into your stocks and shares portfolio, even if you could liquidate those pretty quickly, because you could even be locking in a loss. If that extra money is going to allow you to buy more stock or have a competitive edge somewhere, then of course the value of that money is going to go up. If you need to use that money very, very quickly, it might be to grow your business, to hire someone, or you're happy to play the stock market and happy to try and wait for those potential lows, and you're happy to balance that risk and reward, then I can see having cash will be very, very useful for those individuals. If you wanted to put a percentage on this, you could say something like 5 to 20% of their portfolio could be held in a separate cash fund ready for those opportunities. But that really will depend on the investor, and that really will depend on that entrepreneur, that kind of person who's got the side hustle going or needs to act quickly and knows they need to act quickly. And then what about scenario 3? Let's say you're nearing retirement, or you might already be recently retired. Let's say you've retired even a little bit younger too, so you've got your whole life ahead of you. In that scenario, what do you do about cash? So you've made it out the rat race early, you've been saving diligently, and now you've got your nice portfolio of stocks and shares, and you're trying to figure out how this is going to pay your bills every single month and work out how it's going to make it last you maybe for the next 20, 30 or 40 years. Well, this one's going to be a really difficult balancing act because it all depends on where that person is in their life. So for example, have they kept their living costs quite low relative to what they want to retire with? And does their investment pot match their lifestyle requirements? So for example, are they going to have a portfolio which is going to pay out dividends every month that can cover all those living costs? Or does that person actually have to sell part of their equity to pay for their bills every month? In that position then, potentially cash might be a good option, and have that cash set aside to pay for the next 3 to 6 months worth of expenses, just in case the market has a bit of a downturn. And potentially these kinds of people also could use the bond market just to weather the storm a little bit. Although it may not necessarily beat inflation, it will at least protect their assets, while the rest of it potentially still enables them to grow. But really in that retirement stage, it's all about preservation, making that money last as long as possible. Potentially if you have enough money, of course, you may never have to sell anything, and that money could even continually grow for the next 20, 30 years, and you never actually end up depleting it. However, if you're on the edge somewhere, potentially holding a little bit of cash and making sure that you sold a bit of those investments and held them as cash could hold some advantages in the short term. Alternatively, you could just call that a larger emergency fund, say 6 or 12 months, rather than the 3 to 6 that you might call someone who is of working age. Okay, so let's wrap this up. What's the summary? What's the conclusion here? What have we learned through this video? I think cash can be both your best friend and your worst enemy. Cash can make you millions and millions of pounds with the right opportunity and the right investment. It can also burn a hole in your pocket and lose value quicker than the graphics card in my computer. How much you hold will depend completely on your personal circumstances. But generally, as a bit of a rule, you could say a larger and wealthier a portfolio gets, potentially you may want to hold more as cash, especially if you were more of an entrepreneurial person and you wanted to hold a bit for different kinds of investments, may even be those investments outside of the stock market, or you're a keen stock picker and you're happy balancing that tightrope of risk and reward and waiting for those deals to come along, and you've got a very specific target in mind. And also, if having cash outside of your emergency fund is genuinely going to make you sleep better at night and make you feel more comfortable, then those reasons are far plenty enough for me to say absolutely fine, go ahead with it. Not every decision you make in your life is a completely cold, calculated one, and if having more cash set aside outside of your emergency fund makes you feel comfortable and means that you're going to be available to invest in something, or just have that knowing in your mind that you've got that, then that could be really, really valuable indeed. For me personally, I'm pretty much all invested at the moment. I've got a very small amount of money set aside outside of my emergency fund, which I could potentially dip into, but I've got the peace of mind that most of my investments are working for me. I've got my emergency fund set aside, and then just a small pot of money for everyday investments or any opportunities that come along. One little bonus tip for everyone who's made it this far, and I know the interest rates are so low at the moment and bond yields are pretty much rubbish, but potentially in the crypto market, in the stablecoin space, there could be an opportunity for you to make some good money. So at the moment, I've invested into Nexo and BlockFi as my kind of favored positions to get interest on my crypto. Both of those platforms offer you interest on your stablecoins, and Nexo, for example, offers up to 12% on your stablecoins. So potentially you could just transfer your pounds or dollars there, even converting it to USDC or similar, and actually you could have your money working for you. And although it's not as regulated and it's a lot more risky, these are still backed assets and collateralized assets, so potentially that could be a good opportunity there, and you'd not only weather the storm of inflation, but you'd actually do pretty well too, beating most market returns on average for the last 100 years or so. Anyway, with all of that said, I really hope you found the video useful. Drop me a like if you had, leave some comments down below and let me know if you have any cash on the side or if there's any opportunities you think I've missed anything here going through those different scenarios. Subscribe for more. I'll see you guys in the next one.